Hello, everyone, and welcome to this webinar, Beyond Bitcoin and Ethereum, Building Smarter Portfolios. My name is Zav Witdouck. I am lead of the portfolio engineering team at Talos Trading, and I'm here with Adam McCarthy from Kaiko, who is a research analyst who's been deeply involved with the construction of the KT10 Index. Today, we're going to spend about 30 minutes going through the KT10 Index construction process and the research methodology behind it. And then we will also demonstrate how the Talos platform can be used to leverage this index for doing both research and index replication strategies. We're going to spend about 30 minutes here today, but to start off with, let's kind of dive into the KT10 Index, research methodology and construction process. And Adam, you've obviously been intimately involved in that process. Can you tell us a little bit about, the motivations behind the index and what the research process underlying it has been?
Yeah, for sure. And thanks so much for having me. Look forward to chatting about this. And I guess, it's a good place to kick off with the KT10. I think the Kaiko 10 is our flagship blue chip product. So we've got a KT5, we've got a KT15, but I think the 10 is the ideal sort of broad-based index that we believe anyway that you can track the performance of the market with. So we like to kind of push that as, if you want to get a kind of broad indicator of how the market is going and sentiment, this is your best sort of benchmark for that. We'll obviously talk about, there's products now that are coming into being launched in the US. There's some in Europe already that track 10 basket assets, and there's others that track, more 15 and 20. We believe right now that where the market's at in its maturity, that sort of a 10 asset index is the sort of best one to kind of lead that way. And
can you tell us a little bit about, the asset selection process? I mean, how do you choose the 10 constituents?
Yeah, for sure. I think it's because we're a data company first and then, index company as well. We've got a sort of data-driven approach to that. So it's sort of from the quantitative side, we're using our underlying data to look at the underlying market there and the spot markets on different exchanges. So we look at vetted exchanges that kind of have enough liquidity and enough volume. And then we look at the assets on those exchanges, what their liquidity looks like there and what their volume looks like. So we give it a kind of 75% on market cap for the top 10. So we rank by 10. We rank by top 10 by 75% market cap, 25% on liquidity. So that means that not only are these the biggest assets that you're getting, you're also getting the most tradable in a sense, so that you can move in and out of these assets easily. So that when we will come into why that's important later, I'm sure we'll talk about the Talos platform. We'll see that the benefit of having those more liquid assets in that portfolio. But also there's other things as well, like I allude to kind of ETFs and products on these as well. I think nearly every one of the assets in the Kaiko 10 has one of either a kind of regulated spot, futures, or options market on it somewhere at this point in time. So this kind of helps as well to kind of broaden the strategies that are kind of playable on these indices, which kind of help them to be replicated and to be tradable.
Interesting. And so the weighting scheme is not purely market cap based, right? I mean, you have a capping methodology, so you can explain how the capping methodology works and why you chose that?
Yeah, so I think some indices in the crypto space decided to go uncapped. And that's, there's one way of doing it, but I think the problem with crypto right now is kind of in its kind of nascent way it is, if you go uncapped, you're going to end up maybe at sometimes with 70 or 80% of the index kind of being weighted towards Bitcoin. And I think Bitcoin's market cap right now is just below 2 trillion. And the whole total market cap of crypto is just under 3 trillion. So it's if you don't cap, then you're just really getting exposure to Bitcoin plus, the rest and change. So I think capping it at 30% helps us to kind of limit that and actually give a broader exposure and diversify the index a little bit more.
Right. So when you cap the weight at, say, 30%, you then prorate any weight above 30% equally across the other names, or how does that work?
Yeah. Essentially, that's how we do it. Right. So it's done that way. Yeah.
Okay. Interesting. Well, I guess, obviously we've done some work here to integrate, the KT10 Index onto the Talos platform to allow investors to leverage that index. To either manage, run index replication strategies. And I guess let's kind of take a look into the way you can actually leverage that index on the Talos platform. So what we're looking at here is kind of the landing page of Talos Portfolio Engineering. Just to kind of give you a brief overview here, you can see these different tiles represent different applications or functionality on the platform. So we have a rebalance tool that allows an investor to rebalance a portfolio in a very systematic way using an optimizer. So very good for using for running index replication strategies or active strategies as well. We have a tool for creating and managing benchmarks, and this is where we've essentially integrated the KT10 Index. So if I go into the screen here and I select the KT10 Index, you can see some summary statistics for the index on the platform. So we've backfilled it in this environment back to 2019. Here we can see the NAV. So I think the NAV is kind of fixed, initialized at 100, and so you can see how that NAV has kind of evolved through time. You can see the minimum weight of a constituent here. So it looks like roughly 1% is where you'd see on average the minimum constituent weight, which is certainly reasonable. And then I guess the maximum weight. So you mentioned obviously it's capped at 30%, but just remind me, Adam, this is rebalancing it quarterly. Is that right?
Yeah, so we rebalance quarterly, and part of the reason for that, I mean, you see some indices doing monthly, but right now the trade-off in costs between rebalancing monthly and getting kind of upside versus rebalancing quarterly and accepting the weighting changes, it's not quite there. So it's easier, it's more cost efficient to rebalance quarterly right now.
Right. Okay. Understood. Yeah. So I guess even though at the rebalance points you cap the weights at 30%, intra-quarter we could see constituent weights go as high as as 40%. And I guess interesting here, looking at the median weight, so sort of around 5% fairly consistently, and then we can see the standard deviation of those weights also being pretty consistent between 10 and 12%. So it looks like a pretty diversified index by design. Okay, so we've talked a little bit about so rebalancing. We have this tool for creating and managing your own benchmarks. We won't kind of cover all of this, but we also have a high fidelity backtesting tool. So a very obvious question that an investor might have for something like the KT10 Index is like, how much AUM could I realistically run on that index? And so the backtester allows you to run a simulation where you can impose transaction cost assumptions, ADV constraints, and various other constraints in the portfolio construction problem, and then start the simulation with an assumed AUM. Say it's $1 billion, 10 billion, whatever it might be, and then get a sense of how much tracking error you're going to realize given the constraints on the problem. And so that's a very powerful tool, for assessing capacity of the index. We also have a reporting tool that allows us to decompose the risk and return of any portfolio, but obviously of the KT10 Index as well, to understand what the drivers of performance are. So looking at the common factor versus asset-specific risk and return. So that's what our reporting module allows us to do. And then our modeling tool is really a very powerful framework for creating models and analyzing the risk and return opportunity set of a particular investable universe. And so I think probably it makes sense for us, Adam, to kind of dive into this modeling tool first, just to provide, I think, a very visual representation of the diversification benefits that the KT10 Index provides us. So let's kind of navigate into that. So I'm going to focus on, we've built a few models here, of the KT10 Index, versus other types of constructions. But before we kind of delve into any of that, what I wanted to do was just explore, the risk and return opportunity set of the index itself, versus other investable universes. So, what we have here is we have a tool called the Model Explorer, and essentially, the purpose of this tool is to understand the risk and return opportunity set of an investable universe. And to start things off, very easily, let's just take a single asset portfolio, which is just 100% invested in Bitcoin. So we'll just choose Bitcoin as our single asset here. And what we're looking at here is a single point on this chart, which the x-axis is annualized volatility, the y-axis is annualized return. And we're looking at essentially returns. These are realized returns based, starting in the beginning of 2020 up to today. And this is basically showing that a portfolio that was 100% invested in Bitcoin yielded a return, an average annualized return of 46%, and an annualized risk of about 53%. And the ratio of those two, yield what is called a Sharpe ratio of 0.87. So that's a pretty good Sharpe ratio, a sort of measure of risk-adjusted return over the past 5 years. And obviously, we should be clear that past performance is no indication of future performance, but this is kind of fairly informative analysis anyway. And so what I'm going to do now is look at another construction of, say, 100% Ethereum. So we get a second point on this chart. And so you can see Ethereum is a higher risk, or at least historically over the last 5 years has been a higher risk, higher return asset. But as you can see, a very, very similar Sharpe ratio, a Sharpe ratio of 0.85 versus 0.87. So from an efficiency perspective, you can think of 100% Ethereum portfolio and 100% Bitcoin portfolio as being very, very interchangeable, although obviously Ethereum has realized significantly higher risk at 69%, of 69% versus 53% annualized vol for Bitcoin. Now, where things get a little bit more interesting here is if we look at a portfolio that is composed of Bitcoin and Ethereum together. And so here you kind of get a sense of the efficient frontier. What we've done here is generated 50,000 random allocations of Bitcoin and Ethereum, and we've essentially calculated the risk and return of those 50,000 random portfolios using historical returns of the past 5 years, and that shows essentially the best portfolio that we find on this curve does actually yield slightly better performance than Bitcoin or Ethereum by itself. So you get a Sharpe ratio of 0.9 versus 0.85 for Ethereum and 0.87 for Bitcoin. Now let's take a look at let's take a look at the KT10 index constituents. So we're not looking at the index itself, but we're looking at the constituents that make up the index to understand the risk and return of that index, of those index constituents. So what the system is doing here is generating 50,000 random combinations, random allocations of the 10 assets in the KT10 index, and then calculating the risk and return of each of those portfolios, using past 5-year returns. And so what we want to be able to do is compare how those portfolios, those 50,000 portfolios, compared to just pure Bitcoin and Ethereum. So I guess the first thing here, you can see this cloud of orange dots. These are the 50,000 random allocations, fully invested random allocations of the KT10 constituents. And one of the first observations we can see from this analysis is that over the past 5 years, pretty much any allocation of those 10 constituents was superior than Bitcoin alone or Ethereum alone or any combination of Bitcoin and Ethereum. I mean, obviously, if we kind of zoom in here, you can see there are some portfolios that were, very close, but the vast majority of these of these portfolios, had better, risk-adjusted returns. And I guess if we look at the Sharpe ratio, so here what we're showing is the Sharpe ratio of the best portfolio of these 50,000 random allocations. And this comes up with a Sharpe ratio of about 1.27, which is kind of material. We're looking at almost a 30% increase in Sharpe ratio over just pure Bitcoin and pure Ethereum. So I'm sure, Adam, this must be very comforting to you guys to see this kind of visualization, right?
Yeah, and it's what we see in the research as well. But I think a kind of good point as well to stick on the Sharpe ratio, because we've talked a lot about the kind of technical terms here, and my marketing team would kill me if I don't say like we ideally look for something with kind of a Sharpe above 1. Obviously, a 0.8 for whatever we're getting for Bitcoin there is still very good. But a Sharpe of 1.27 is really great. So to see that with the kind of assets that we have in the KT10, it's quite encouraging.
Yeah, and just I think one of the other interesting observations here is so on the chart, on the pie chart on the right here, what we're showing is the allocation of the best portfolio historically over the last 5 years, what those allocations were. And one interesting thing to note here is just the fairly sizable allocations to altcoins, right? I mean, in fact, here you can see a relatively small allocation to Bitcoin and Ethereum, and a very, very kind of broad allocation to altcoins, which I don't know. Some people might find that quite surprising. In fact, the largest allocation, and interestingly, it's just below 30% here, is Solana. Does this kind of correlate with your research as well? And is maybe this why you chose the 30% max market cap?
Yeah, I think what we're seeing with having that max market cap is that you can capture that upside from those kind of smaller, lower cap coins, for sure. That's why we want to kind of cap it, so that you can see those gains. I think we see quarter to quarter at times that the largest contributors to a performance at times has been Sol, has been XRP more recently. So certainly that's where that kind of benefit comes in from capping, in that sense that you don't miss that upside. Because I think if you uncap, there can be a sort of like selection bias towards Bitcoin, in a sense. And then I guess this is like super interesting to see and like visualize the performance of these. Who's using this who's using this tool then? Kind of, is it ETF issuers, is it funds, or who's the idea?
Yeah, I mean, all of the above, right? So I think if you think about a research process, so we see a lot of clients who are in product development mode and doing research and development, trying to look at what kind of products to bring to market. Obviously, the success of the Bitcoin and Ethereum ETFs, I think has been noticed by a lot of investment managers, because there's clearly demand for crypto exposure. I think the natural next question is what are the next products, right? And I think it's pretty clear from this analysis that providing more efficient beta exposure to crypto is a genuine thing, right? I mean, I think a lot of people are under the impression that the diversification benefits within crypto are not really there, but I think this analysis kind of shows that is clearly not the case, right? There really are diversification benefits, and I think a lot of people are experimenting with different weighting schemes. Obviously, as you said, market cap is not appropriate given you get very skewed portfolios to Bitcoin and Ethereum, but there's a lot of kind of fundamental weighting schemes that are being analyzed for building like smart beta type products, and then even going into alpha research as well, right? So we're seeing really demand across the spectrum, from beta to smart beta to alpha type products. And I think that kind of, obviously this analysis is really just looking at the choice of constituents, right? So you can kind of say, well, okay, does adding a particular name to an investable universe, does it provide me diversification benefit or not, right? I guess what we haven't really talked about is the actual KT10 index construction itself. And one of the things we've done here is we've generated a number of models. Most of these are very simple models. But here is an example of just Bitcoin versus the KT10 index itself. And so we provide sort of detailed analytics to show performance, risk. So this is risk in terms of. So here we're looking at active risk. So this is essentially tracking error. We provide histograms of returns, drawdown in terms of magnitude and duration, interval returns, and then we provide analytics like information ratio, Sharpe ratio, and other types of performance metrics. But one of the things that we found kind of interesting here is that we looked at, we took the 10 constituents of the index and generated an equal weight model, which rebalanced on a monthly basis. And we showed here, that obviously the KT10 index significantly outperforms an equal weighting strategy. And then we also took sort of square root of market cap. So we often use square root of market cap as a proxy for creating diversified indices, because it's a kind of a simple routine for creating or ensuring that Bitcoin and Ethereum don't dominate. But even the square root of market cap construction doesn't perform anywhere near as well as the KT10 index portfolio. So that is kind of also pretty interesting to look at. And I think here we did a pure market cap weighting. And so here, it's kind of less convincing. I mean, there's obviously underperformance and some overperformance through the history. But I think one of the key things here is that, you just don't have the same, diversification benefits, right, as the index itself, using market cap weighting. Any thoughts you wanted to add to that, Adam?
No, I think it's super that you can kind of just use this kind of plug in the KT10 to kind of see this in different ways and visualize it. So it's super interesting to me. I guess you touched on tracking error and stuff there as well. So I think we're going to discuss replication as well soon. So like interested in seeing how that works and how you guys track those things as well.
Yeah, no, I mean, tracking error, obviously, if you're running an index replication strategy, tracking error is very material, right? I mean, ultimately, an investor wants to see as small a tracking error as possible. I mean, the reality of managing a real strategy means that you obviously going to have to have some cash drag. I mean, a fund is going to be liable to fees and other things. And so you can't invest 100% of the capital. And so you're going to realize some degree of tracking error. But these tools essentially allow you to understand the magnitude of that, under what regimes and under what conditions that tracking error is likely to be higher or lower. And certainly, as you're dealing, obviously as an index strategy, you're probably dealing with daily liquidity. So you're having inflows and outflows. And so you need to manage all of that complexity in a fairly systematic way. And so, yeah, I mean, it's a good segue into the portfolio rebalance tool, because this is really the last section that we wanted to demonstrate how an investment manager can actually run and manage a strategy on the Talos platform, to replicate the KT10 index. And I guess what we're looking at here, we've created a sample portfolio that is initialized with just $1 million of cash. If we look at the exposures at the bottom half of the screen here, we can see the actual benchmark weights as they are currently. Now, obviously, I'm not sure when the next index rebalance is for KT10. Is it in April?
Yeah, it'll be this week actually. So
it'll be this week. Okay. So yeah, we're at the very tail end of the rebalance window, and so we can see that Bitcoin's kind of rallied, and has a 37% weight in the index currently, 23% for Ethereum, 13% for Solana, but still nicely diversified. And we can see that for this particular portfolio, our start of day holdings is 100% invested in cash. So we have no exposure to the index at all at this point. And so what we're going to demonstrate here is how PM can actually do an inception rebalance to get the portfolio into its target allocations. Now, I just want to call attention to a number of columns here at the top here. So you can see we have a group of tracking error columns for holdings, our optimal portfolio, and our terminal portfolio. And obviously, because we're completely uninvested at the moment, we're essentially 74% tracking error, which is obviously enormous. We would really ideally want to see tracking error in basis points, rather than percentage. So we got very high tracking error while we're totally uninvested. And before we actually go ahead and do the rebalance, I just want to kind of call attention to some of the features that the PM has control over. But we have this concept called the portfolio objective. And the portfolio objective is really a very precise specification of the terms and conditions by which how the portfolio has to be managed. And so we've obviously pre-configured this this particular objective for this webinar. And so here you can see I've configured the Kaiko Top 10 Index as our benchmark for this investment strategy. We could impose beta constraints against that benchmark if we want to, but we haven't in this case. And we've chosen our Crux 30 factor model as a means of measuring active risk in this portfolio. Generally speaking, investors will use or generate their own proprietary factor models on the platform, using their own set of parameters. But here we just use this Crux 30 as a demonstration. When it comes to the investable universe here, you have precise control about what assets you're allowed to hold in the portfolio. But this one's pretty simple. All we've done is said, okay, we can include any assets that are in the benchmark as being part of the investment universe. So that's pretty straightforward. And then I think we've imposed one holding constraint to retain 25 basis points of cash in the portfolio. And so this 25 basis point buffer is there, to cover fees of the strategy. But also, when you're rebalancing a portfolio in the real world, you don't actually know exactly what prices you're going to fill at. And so you need to provide some form of cash buffer to ensure that you don't overdraw the portfolio, because maybe, like in this case, we're going to be investing cash into tokens, and so we're going to be buying across the board. And obviously, if I try to buy exactly my AUM, exactly $1 million, I may end up buying $1 million and 1,000, maybe because markets rally during the rebalance process, in which case I would overdraw. And so by having a 25 basis point buffer, I can ensure that I don't overdraw my cash in the portfolio. Now, there's many other controls that an institutional investor can use here, and so that might be, if you're running an active strategy. Obviously, here we're just using a passive investment strategy, but you can enable transaction costs and do many other types of controls, through this screen. But now, let's go ahead and actually generate some orders and transact our strategy, or initialize our strategy into the index. And so all I need to do here is click optimize, and essentially what this is going to do is use all the rules defined in that objective. It's going to take the benchmark weights and calculate what we call our optimal weights. And these optimal weights are essentially the weights that minimize tracking error to this index, subject to the constraints. And one of the constraints we imposed was obviously the 25 basis point cash constraint. So you can see it's left us 25 basis points in cash, and then invested the remainder across the different tokens. And it's not done that in just a pure pro rata fashion. It's done that using the risk model in order to upweight and downweight names in order to minimize tracking error. And we can actually see here, if we go to the top right of the screen, we can see that the optimal portfolio brings our tracking error down to 13 basis points. And obviously most of that tracking error is going to be attributable to the 25%, the 25 basis point cash drag. Now let's assume that we're happy with these weights. I can then go ahead and generate some orders to rebalance the portfolio to its optimal weights, and I can I'm going to obviously trade these today. I'm going to just run market orders to keep this simple, and when I click OK here, this is now going to go ahead and generate me some orders. So you can see my order tab. I've now 10 orders in my order tab. We can actually see the exposures in percentage of NAV of those orders. So you can see we're spending 99.75% of our cash and then investing those into the tokens. And if I go to the order tab here, I can actually see, it's, the way this particular portfolio is configured is to use spot pairs against US dollar. And so here I can actually see the order quantities that have been sized. I can go ahead and approve these orders. Obviously, we support like 4i approval, but I can approve my own orders in this webinar. And then I'm going to go ahead and let's just make sure I've got these configured correctly. Yeah, for the simulator, I'm going to go ahead and execute these orders. One of the major benefits of the Talos platform is obviously, providing unified access to many different liquidity providers. So here I can see all the dealers and exchanges that I have access to in this environment. So I'm just going to say I'm going to direct these orders at all the dealers and exchanges. And so this will use smart order routing under the covers using the Talos trading platform. And if I click OK now, it'll essentially send these orders to the Talos trading platform. And since these were market orders, these should effectively just get done immediately. And so you can see these orders are now all executed. I can actually see the average prices that I got filled at. So if we look at AVAX here as an example, this first one, we sized the order at 18.86. We got filled at 18.89. So a little bit of slippage there. Bitcoin, we sized at 83,221. We filled at 83,357. And so now if I go back to my exposures here, we can now see my trades, have been executed. Obviously, because of that slippage, we spent, slightly more than, we expected. So we actually only have 16 basis points of cash remaining. But that's, perfectly fine. The reason we had the 25 basis points is, we wanted to make sure we didn't overdraw, and that's given us, plenty of buffer. And in fact, the good news is that our tracking error is even lower than we were originally expecting. We're now running at 6 basis points of tracking error versus the index, which is really small tracking error given our cash buffer. So I think hopefully that gives us a good overview of how to run and manage an index replication strategy on the platform on Talos.
Yeah, it's super interesting to see that and how the Kaiko 10 can plug in there and be used. So it's encouraging to see kind of that in action, getting it to kind of be used for this kind of thing is very cool.
Yeah, no, I mean, I think the tool provides investors a very easy and robust means for running these kinds of strategies and much more complex strategies at scale. So obviously some investors will use the Kaiko 10 Index as a benchmark within an active strategy. So if they're trying to outperform that strategy, they can also use the same tool to run active strategies. But I think what we've clearly demonstrated here today, I think investors who are interested in getting crypto exposure, I think there's clearly diversification benefits for holding a broader universe. I think clearly thinking about how you weight a broader universe, there's clearly some degree of analysis and skill that goes into that, and I think the KT10 Index is I think a really smart and useful way to think about sizing those allocations, to give that very diversified portfolio. And I think as we kind of evolve into 2025, I think we're going to see a lot more asset managers coming to market with diversified crypto exposures, that are going to provide investors with much more efficient exposure to crypto. So we're super excited about that, and I'm sure you guys are too.
Yeah, I'm very excited. I think we've already seen it as well. I think there's maybe 40 plus ETF applications in the US that range from spot products on altcoins to basket products on a bunch of different assets. So we're excited about that prospect. I think the KT10 is a kind of good barometer for those things going forward. So looking forward to what's to come.
Yeah, and I think with the regulatory environment clearing up in the US, I think we're likely to see much more broader based ETFs. As I say, I think 5, 10, 15 asset universes, just like you have the index products for that. I think we'll definitely see those very shortly.
Okay.
But anyway, thanks for your time today, Adam. It was good chatting, and hopefully this webinar will give our audience a really good sense of the benefits of diversification in crypto, and how you can use the Talos platform to research and manage complex strategies like this at scale.
Thanks for having me. It's very cool to see how Talos works and see the KT10 plugged into it. So really enjoyed it.
Appreciate it. Thanks, Adam.